Hey guys, how's it going? I'm Lewis Harding Invest and welcome back to my channel. And in today's video, I'm going to be going through 3 stocks to buy now in December 2021. Let's get straight into it. So the first company on my list is BP. So BP plc, formerly known as the British Petroleum Company plc, is a British multinational oil and gas company headquartered in London, England, and it is one of the world's 7 oil and gas super majors. So it is a vertically integrated company operating oil in all areas of the oil business, so upstream, midstream, downstream. But we're also now getting into renewable energy with interest in biofuels, wind power, smart grid and solar. So the company has operations in nearly 80 countries worldwide, and it produced 3.7 million barrels per day in 2018. So yeah, that's a lot of oil. The largest division is in America, so BP America. They also have a nearly 20% stake in Rosneft, the world's largest publicly traded oil and gas company by hydrocarbon reserves and production. Interesting stuff. BP has a primary listing on the London Stock Exchange, and it is a constituent of the FTSE 100 index. So to start with, we will have a look at the genuine impact stats, and yeah, so genuine impact has 3 main sections: quality, value and momentum, and I usually look at the 2 which are most relevant to me, so quality and value. So we'll start with quality, and yeah, unfortunately it's looking pretty low on this section. Low profitability, weak financial strength and poor capital allocation. Not great, to be totally honest. But then we'll move over to the value section, and it's looking very cheap on all accounts. So yeah, it's looking like it's a cheap stock, but with poor financials. So yeah, we'll have to see what my analysis shows, but not a great start apart from good value. Then the growth metrics in the bottom left hand corner, not too good apart from the dividend going up. So questionable if that dividend can be continued, but we will just have to see. So now to my analysis checklist, and BP PLC is listed in London, and it is a constituent of the FTSE 100 index, one of the biggest companies on there. Yeah, let's get straight into the analysis. Profitable, high returns on capital using low leverage. Yeah, not fantastic profit wise. Got to think though, the pandemic will skew these figures quite a bit. If they were loss making in 2020, which I'm sure they were, because oil absolutely tanked, the margins would have been wiped out, and it'll make these 5-year averages look probably a bit worse than a normal year. But hey ho, we've got to do the same process for all companies. So yeah, low gross margins and low net margins, not good. Return on equity, not great either. But yeah, the debt situation is okay, I guess. I guess when you're not making much money, you can't have much debt because you'll just default and go bankrupt. So yeah, it does make sense. Proven ability to grow, not looking great. Revenue, net income, not growing in a 5-year period. Pandemic, the likely cause. Free cash flow is up though, so a bit of a disconnect between free cash flow and earnings. So something you have to research, of course. Great capital allocation, so yes, they have issued a fair bit of debt, like a lot of oil companies have. Dividends have grown, which is good. They've issued some shares, probably to get through the pandemic once again, rather than issuing a load of debt, issue a bit of debt and some shares. And then yeah, good acquisitions. I'd probably say this is a yes, due to the renewables acquisitions they've been making, so, and the transition of the business over the next however many decades into green energy. Buy at a fair price. This is what attracted me to BP to do this video, to be included in this video. P/E ratio of 14 and the price to free cash flow ratio of 8, so cheap on them accounts. And then yeah, my DCF valuation for a 10% return, we're looking at a share price of £5.91. Yeah, we'll go over to the DCF to see how we got to that figure. Now moving on to the DCF for BP, and I have taken my free cash flow estimates from Market Screener, and yeah, you can see that 2020 was negative free cash flow, so probably due to the earnings absolutely tanking, not bringing any earnings or free cash flow. But then looking into the future, it's looking quite positive free cash flow wise. So if you think the worst is over for oil companies and BP in particular, for a 10% return, a share price of £5.91, interesting stuff. Yeah, it all depends on the oil price, doesn't it, really? If you think the oil price is going to stay high due to inflation or supply issues, whatever, yeah, it could be an interesting buy. But the only issue with oil companies is, very much linked to the oil price. It's the nature of the business, so something to be aware of, but it might be a good opportunity to buy now. So the next company on my list is Kingfisher plc. So Kingfisher plc is a British multinational retailing company headquartered in London, but they have regional offices in the UK, France, Poland and Romania. It has over 1,300 stores in 9 countries, and the 2 main brands you will recognise are B&Q and Screwfix. Kingfisher are listed on the London Stock Exchange and they are a constituent of the FTSE 100 index. So we will have a look at the genuine impact stats for Kingfisher, and we'll start with the quality metrics. It's showing medium overall, so profitability wise it is showing pretty high, likely due to the 2020 earnings having a really good year, Screwfix and B&Q in particular. Financial strength and capital allocation are medium, so not too bad, not great, not bad, in the middle. Value wise it's looking cheap on all aspects, so really good to see. Decent financials and very good value, so we'll see what the DCF spits out, but looking decent from a first glance from genuine impact. Bottom left hand corner, let's have a look at the growth. Revenue, earnings per share, all growing. Free cash flow to equity growing as well, awesome to see, and then dividends growing per share as well, so not too bad. Now let's have a look at my analysis checklist for Kingfisher plc, and the company is listed in London, market cap of £7 billion, so a smaller company compared to what I've analysed before, I guess. An earnings yield of nearly, 12% rounded up, that's pretty high really, and a P ratio of 9, so another reason how I found this company when doing some screeners on UK companies. Let's have a look at the pillars, and gross margin 37%, nearly at the 40, not quite there. The net margins are quite low for this business. It is a retail business at the end of the day. They don't have the best margins going on. As long as they're consistent, it's decent, but I like to have higher margins because higher margins usually means higher quality business. Return on equity not fantastic, a bit miffed to be fair. But yeah, the debt situation's good. We don't have much debt really, long-term debt to equity. And I believe that's actually total debt to equity because I couldn't find the split figure. And current ratio above 1, just a simple figure you like to see really. You want liquidity in the business if anything goes wrong. Proven ability to grow, so yeah, revenue growth over the past 5 years. Net income misses out by, 1.8 million, so not too bad, but red nevertheless. Shareholder equity growth is actually down. This is probably due to paying out more dividends and profit they've been making in recent years. But free cash flow growth is up, so that is the big mama jamma we like to see. Great capital allocation. Unfortunately, long-term debt repayment. I think they issued some debt due to the pandemic, which will make that score a red. But they've probably done this to show up the business, and you can see they don't have much gearing anyway, so you don't want them to increase it much by much, but hopefully they can start repaying this back over the coming years. Dividend growth, they cut the dividend, so that's an X. Hopefully this comes back and it's reinstated at what it was. Shares outstanding, increasing. Pandemic once again to raise finance. Good acquisitions, I'd probably say yes, good acquisitions. I haven't really looked too much, but as the business owns B&Q and Screwfix, 2 of the most popular, DIY stores in the UK, I'd probably stay doing pretty well. Buy at a fair price, yeah. So P ratio and price to free cash flow ratio are looking very attractive. Very low. Anything below 10 for a price to free cash flow is pretty incredible. That's pretty much saying that in 7 years you'd get all your free cash flow paid, so impressive really, very impressive. But yeah, DCF valuation for 10% return, not quite there, so £2.90 is what I've got it at. And the current share price of when I was recording, you'd have to drop by 14%. But it's been there over the past year, so there's no reason why it can't get back down there. But let's have a look at my DCF to see how I got to them figures. Now let's have a look at my DCF valuation for Kingfisher, and again, the analyst estimates are from marketscreener.com. And yes, you can see from 2021, the free cash flow was absolutely massive, had a massive boom because of the pandemic, everyone being at home and going to B&Q and Screwfix every weekend. So the free cash flow is expected to decrease, but yeah, this is expected just to be a steady figure going up over time. which is you just want it nice and consistent, going up over time, of course. Discount rate of 10%. It's coming out with a share price of £2.90. That seems reasonable, to be fair. And if you can buy it below this price, then you're probably getting a half decent deal. But yeah, I wouldn't want to be buying Kingfisher above my £2.90. It looks like a decent business, but not something I'd personally want to get into myself. But just to show you that there are opportunities out there in the market where you can get, a 10% return if you're patient enough. So the final company on my list is ITV PLC. So ITV is a British media company that holds 13 of the 15 regional television licenses that make up the ITV network, or Channel 3 if you're an OAP. The oldest and largest commercial terrestrial television network in the UK. Well, that was a bit of a tongue twister, wasn't it? ITV PLC is listed on the London Stock Exchange and is a constituent of the FTSE 100 index. Now let's have a look at the genuine impact stats for ITV, and we'll start with the quality metrics. It's a bit across the board really. So profitability is pretty high, financial strength is looking weak, and then capital allocation is sound. So very mixed, which brings up a medium score. Value wise, it's looking cheap on most metrics apart from balance sheet. That's likely to do with some debt, but the income statement and cash flow statement looking very cheap, which is pretty exciting really. And the forward PE is 7. That's pretty low for a company in this day and age, so not too bad. Historical growth, unfortunately it's showing up as low revenue growth, not a good thing at all. But then the rest of it is looking decent, so yeah, something to look into. It's a bit subdued from looking at some of these figures, but let's have a look at my other analysis to see what everything spits out. Right, so now to my analysis checklist for ITV PLC, and the company has a £5 billion market cap. P ratio of 14 and an earnings yield of 7%. So yeah, cheaper than the market. So another reason why I was interested in this stock to analyse. So profitable, high returns on capital and low leverage, gross margin and net margin. It looks on Morningstar and we're showing the same figure, so I've just put the same figure. So they must not really have a gross margin, and if they do, I couldn't be bothered to work it out from their accounts. But anyway, the net margins are pretty decent, to be fair, very high for a UK business anyway. Return on equity, very, very solid, no complaints. Long-term debt to equity is a bit high for me. It's double where I'd want it. And it's a reason why I probably won't buy this stock, to be honest, because I'm very, very conservative with how much debt a business has. It can just put me off completely if it has too much debt. Current ratio is solid though, which is good. I think this just shows that the business is financed by long-term debt. Proven ability to grow, revenue growth and net income's down over the past 5 years, although shareholder equity and free cash flow is up. So you'd maybe want to have a look at the free cash flow compared to the net income. What are the differences and why are they similar over time? But then long-term debt repayment. Looks like with the pandemic they issued some debt to get through it. So that's a big no. Dividend growth, the dividend's been growing, so fantastic stuff. I've been increasing the shares. I couldn't work out the actual figures, unfortunately, but I did have a look and it was a negative. Good acquisitions. I can't remember ITV ever acquiring anyone, so I can't give them a yes for that. They're just a TV channel, aren't they, really? So I don't know who they're going to be acquiring. But then buy at a fair price. Evaluation metrics, as with the other two companies, all in the green. So, Kingfisher was in the red for the DCF one. We weren't far off. But this is probably the most undervalued out of the lot. For a 10% return, we're looking at a share price of £1.82, and at the current share price, it's looking at a 46% increase to the fair value based on the numbers. So very interesting. If you think ITV is a decent business and here for the long term, could be good. Who knows? But let's have a look at my DCF figures to see how we got to the share price of £1.82. Right, now to the DCF for ITV and analyst estimates from Market Screener once again. Very consistent. It's looking. Required rate of return of 10%. So fair value of £1.82. So if you like ITV, if you think Love Island and I'm a Celeb's going to be here forever, then might be a good shout. Not a stock that I'd be interested in. I'm interested in bigger media assets than ITV, but in terms of the UK, ITV is pretty big, isn't it? So who knows where it's going to go. I think television will be dead in the next couple of decades, if ITV can become digital, which the ITV hope they are doing, if they can keep relevant, who knows, they might be around. But the valuations are currently showing that it's probably undervalued, so it might be a good addition to a portfolio, who knows. So there we have it. There were my 3 UK stocks to buy now in December 2021. Let's go through them again. So it was BP, Kingfisher and ITV. If you enjoyed today's video, please subscribe to the channel. Thank you very much for watching. I will see you next time. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.